So what if I told you Europe has a financial weapon so powerful it could shake the entire American economy without firing a single shot? Not missiles, not tanks. I am talking about US debt. Because Europe owns trillions of dollars worth of US Treasury bonds. And if they ever decided to sell those bonds at scale, the shockwave could hit your savings, your mortgage rate, the stock market, and the value of the dollar all at the same time. And the craziest part, this isn't some conspiracy theory. This is literally how the global financial system works. So today I am going to break this down in the simplest way possible. Europe owns trillions of US debt, so what happens if they sell? Most people think America is a powerful because of the military, and yes, that matters. But in modern time, the true backbone of American power is something much less flashy: confidence. Confidence that the US dollar is stable, confidence that America always pays its bills, confidence that US Treasury bonds are the safest financial assets on planet Earth. That's why government, banks, and institutions across the world buy US Treasuries. Because Treasuries are basically the world's safe parking spot for money. If you are a country like Germany, France, Japan, or even China, and you are holding massive reserves, you can't just keep it all sitting in cash. You need something liquid, stable, and trusted. That's where US Treasury bonds come in. So what Treasuries really are? Let's make this super simple. When the US government needs money, it borrows. And it borrows by issuing Treasury bonds. So when someone buys a Treasury bond, they are basically lending money to the United States government. And in return, the US promises two things: we'll pay you interest, we'll pay you back later. So for decades, this was considered the safest deal in the world, which is why Treasuries become one of the most important assets in global finance. Not Apple stock, not real estate, not crypto. Treasuries. They are used as collateral, they are used by banks, they are used in international trade. They are used by central banks to stabilize their own currencies. So when something big happens in the treasury market, it doesn't just affect investors, it affects everybody. Now here where it gets serious. Europe, depending on how you measure it, owns trillions of dollars in US Treasury bond. And even if you zoom out a specific region and specific countries, the numbers are still massive. This means America's allies aren't just allies politically, they are tied to America financially. It's like the global system is built on one giant agreement. We trust the US, so we'll keep holding its debt. But what happens if that trust starts weakening? Because once trust breaks, things can turn fast. So why would Europe sell? Now let's be clear. Europe isn't trying to destroy America. If Europe crashes the US economy, Europe gets hit too hard. So this isn't about some dramatic one-day decision where everybody dumps everything. The real risk is something quieter, something slower. A gradual shift, a steady reduction, a warning signal that says we are not as comfortable holding this much US debt anymore. And there are a few reasons Europe might start doing that. Number one, political instability. When relationships get intense, countries don't like being financially dependent. Number two, risk management. If they believe the US is becoming less stable long term, they diversify. Number three, de-dollarization pressure. More countries are experimenting with trading outside the dollar system, not because they hate America, but because it gives them options. And once countries have options, US debt stops being that default. So what happens if they sell? Now here's the key mechanism. If Europe sells US treasuries, the price of bonds drop, And when bond prices drop, yields go up. And when yields go up, interest rates across the entire US economy rise. That means mortgage rates go up, car loans get more expensive, credit card interest gets worse. So even the US government itself has to pay more to borrow money. And if America is already running massive deficits, higher rates make that situation dramatically worse. So you get a dangerous feedback loop. More debt, higher interest payments, more borrowing, even more debt. And eventually the bond market starts asking a serious question. Are we sure this stays safe forever? And that's just the first wave of the problem. Because once the selling starts, the next question becomes even bigger. So what happens to the US dollar when trillions of dollars get sold and converted into the global system? So if Europe starts selling US treasuries, the first wave is higher yields and higher interest rates inside America. But the next wave is what happens to the US dollar itself. Because here's the part most people miss. When a country sells US bonds, they get paid in US dollars, and then they do what every government and central bank does. They convert that money into what they actually want to hold long term. Euros, gold, other assets. So the real story isn't just bonds getting dumped, it's the dollar getting it from multiple directions at once. And the moment the world starts moving away from the dollar faster than expected, the US economy gets expensive overnight. For decades, the world has been absorbing US dollars. America prints dollars, trades with the world, and those dollars spread globally. But what happens if countries stop wanting to hold them? They come back. It's like the world has been storing America's dollar in a warehouse. And suddenly that warehouse is emptying back into the US financial system. That flood of dollar doesn't make American richer, it does the opposite. Because when the supply of dollar increases relative to demand, the value of the dollar drops, and a weaker dollar has one immediate effect that everybody feels: imported inflation. So why a weaker dollar hits you fast? So here's what a weaker dollar really means in real life. Groceries cost more, gas cost more, electronics cost more, and phones cost more. Medicines cost more because America's import a huge amount of what it consumes. And even if something is made in America, parts of it often aren't. The materials, components, shipping, fuel, those costs move globally. So when the dollar weakens, the price of everyday life goes up. And the worst part is your paycheck doesn't automatically rise with it. So you get squeezed from both sides. Income stays the same, cost of living jumps. That's how you create real financial pressure on millions of people fast. Now here's where it gets dangerous, because at this point the Federal Reserve gets boxed in. Normally when the economy gets weak, the Fed cuts interest rates to stimulate growth. Cheaper money helps businesses and consumers borrow, spend and invest. But if inflation is rising because the dollar is falling, the Fed can't cut rates without making inflation worse. So the Fed has two bad options. Option 1, keep rates high to fight inflation, but that risks unemployment rising, markets dropping, and growth slowing hard. Option 2 is cut rates to protect the economy, but that could weaken the dollar even more and push inflation higher. So that's what people mean when they say the Fed gets trapped. And this is exactly why bond market pressure is so serious. It forces policy choices that hurt no matter what. The Fed will just print money is not a fix. Now some people will say, relax, the Fed can step in and buy treasuries. And yes, technically it can. The Fed can buy bonds to push their prices up bring yield down, and stabilize the market. That's basically the same playbook we have seen before. But here's the issue. If foreign countries are selling treasuries because they are losing confidence and the Fed responds by printing money to absorb that selling, that doesn't restore trust, it can destroy it even more because the world starts thinking, so the US is funding itself by printing and we are supposed to keep trusting that. That's how you turn a bond problem into a credibility problem. And when confidence breaks, markets move faster than government can react. What this does to stocks plus your retirement. Now let's talk about what happens to investments. When interest rates rise, stock valuation usually come down because higher rates make borrowing expensive. They reduce corporate profits, they slow growth, and investors stop overpaying for future earnings. So stocks can drop, and it's not just Wall Street drama. It's retirement accounts, index funds, pensions, 401k, people's long-term saving. At the same time, the cost of living rises. So you get the worst combination. Your portfolio may fall while your expenses rise. So that's how financial stress goes mainstream. The government can't afford high rates. America has so much debt that higher interest rates are not just painful, they are destabilizing because the government has to refinance debt all the time. If rates stay higher for longer, interest payments balloon and that forces hard choices. Higher taxes, spending cuts, more borrowing, more printing. None of those options are politically easy and the bond market is ruthless. It doesn't care about election, it doesn't care about speeches. It only cares about risk and return. If the market believes America is becoming a higher risk borrower, investors demand higher yields and that feeds the loop again. What the sell-off would look like. Now to be clear, this doesn't have to look like one dramatic headline, Europe dumps US debt in one day. It could happen quietly, a steady reduction in treasury purchases, a gradual shift to gold reserve, more trade deals not priced in USD, more diversification into other currencies, and then one day the market realizes the trend is real. And once that realization spreads, things can move very quickly. So what should you do? And what's the takeaway? Not panic, not doom, not America ends tomorrow. The takeaway is awareness. Because if the world starts reducing exposure to US treasuries and the dollar at scale, the US becomes a more expensive place to live. And when things get expensive, the middle class always feels it first. So if you are trying to be smart during uncertain times, here are a few grounded principles. Keep an emergency fund. Avoid drawing in high interest debt. Diversify your assets instead of relying on just one thing. Don't ignore bonds and the dollar. Those are the real signals. Focus on stability, not hype, because in financial history, the people who survive downturns are not the people who predict the future perfectly. They are the people who are prepared for multiple outcomes. So the real question isn't will Europe sell everything? The real question is the world slowly moving toward a future where US debt and the US dollar are not the unquestioned center of global finance? Because if that shift speeds up, the shock won't start with a crash on a chart. It will start at the grocery store. It will start at the gas pump. It will start with interest rates. And by the time the average person notices, the damage is already done.